So now we're going to cover exercising stock options and some strategies there. So as discussed earlier with stock options, they are something that you must purchase as the option holder. So you do get to make some decisions. Do you exercise your options and actually buy the stock at all? And if so, when? There's generally two time frames that you would exercise the option should you choose to do so. An early exercise and a regular exercise. So an early exercise, if it's available and an option to you within the plan, is something that you're able to do before the shares actually vest. And we'll get into this in a lot more detail in the next couple of slides. The regular way to exercise your stock options is after they vested, but before they expire. So this is a really commonly misunderstood area in terms of that expiration time frame. You can't be late. So if you are to leave the company before the 10-year initial exercise period that comes with non-qualified and qualified stock options, you don't have that same time frame, or at least not automatically. So generally, companies will give you between 30 and 90 days to actually exercise those options after you've separated from service. So again, remember that original 10-year expiration date on the grant, it definitely doesn't automatically apply, and companies seldom give it. One thing that's also important to note here for ISOs is there's actually an IRS statutory limitation on how far out into the future those could be exercised after you leave and still considered ISOs. It's 90 days. After that, if the company is willing to work with you and if you've negotiated for a longer time frame to exercise those options, which it is a negotiable aspect, they would simply become non-qualified stock options at that time. But again, another thing to think about here, if you are planning to leave, is if you were at a public company, for example, and if you're able to do a cashless exercise while you're still there, those options wouldn't be available to you once you've left in most situations. So we're going to go into the early exercise and how that works in the next couple of slides with some examples. So there's really one reason that someone would consider an early exercise, and that is the potential for tax savings, and sometimes major tax savings, by shifting their taxable gain more towards that long-term capital gain bucket and less for short-term capital gains or ordinary income. The other main reason is to start the clock on qualified small business stock, that 5-year holding period, and then, of course, for the long-term capital gains holding period, either non-qualified stock options or ISOs. So incentive stock options are most commonly known for their tax benefits. However, when it comes to what vehicle is the best one for early exercising, it's not usually ISOs. And it's because of that holding period that we discussed earlier, that 2-in-1 holding period. So in addition to that, there's also a limit on how many, the value of ISOs that can be considered exercisable in a year before they become non-qualified stock options, and that there's a $100,000 limit. So if you're given a big grant, it just wouldn't qualify if there are those early exercise provisions, which is another thing to be aware of. Unlike ISOs, non-qualified stock options and restricted stock awards, you only need to hold those for 1 year to get long-term capital gains tax rates. So we've had clients where we've actually suggested they request this type of equity comp instead of ISOs if they are looking to do an early exercise. And sometimes companies will work with you on that. As mentioned earlier, it has to be permitted by the plan. Not all stock option plans allow for early exercises. And making an 83B election is a really, really key part of this strategy. As we discussed earlier, the 83B election is you officially telling the IRS that you wish to recognize income on this exercise when you aren't vested. So it kicks off this whole process of cementing the holding periods that are really important. There's a strict filing deadline for the IRS. It's 30 days after exercise. You can't be late. It's just non-negotiable. So don't forget about that. But without that 83B election, you don't actually start to have the clock tick on that long-term capital gains tax treatment. And it actually can have some pretty adverse consequences in terms of when income is recognized, which we'll get into in the next couple of examples. So what are some of the pros and cons of an early exercise strategy? Again, the potential for big tax savings rather than exercise when the gap is $9 a share. If you can exercise when that taxable spread is $1 or nothing, it really can be a tremendous savings. Again, it starts the holding period for not only long-term capital gains, but Section 1202, which is called qualified small business stock. We will get into that in the next couple of slides, but it's an incredible part of the tax code that is little known. One silver lining to down markets is it can actually reduce that taxable spread. So if you have a down round in this example, where now the 409A isn't $10 a share, but maybe it's $7, well, that can reduce, again, your tax impact. But it's not without risks, right? So leaving the company is one of those risks. The company is actually able to repurchase those shares from you at terms that aren't very favorable to you. So it's usually the lesser of your purchase price, the strike price, or the value of the shares at that time. And if you did make that 83B election, as is common, there's no refund on that tax paid. So you, again, need to keep in mind what your value at risk is in terms of your purchase price and the taxes paid. Mergers and acquisitions, not something that you can control, but that can screw up your plans, essentially. It can trigger a disqualifying disposition of ISOs. It can trigger short-term capital gains, restricted stock or non-qualified stock options. So it's just another thing to be aware of before you decide to do this or not. Stocks don't only go up. We for sure have seen that in the last couple of years, but shares can go underwater, especially if you aren't an early employee with that strike price under $1. We've very much seen it happen where individuals early exercise and now all of a sudden the value is lower, or they are just holding on to the stock and the value is still lower, so those shares aren't worth anything because they're underwater. If you did go ahead and early exercise and those shares become underwater, if the company decided to do something like a repricing to make sure that those equity incentive options still had value because they're trying to be golden handcuffs, they're trying to have employees stick around. If they end up repricing them to sort of fix that problem, you won't be able to participate because you already exercised. Again, there's always an uncertain path to liquidity and an unknown outcome for the stock. So it's just not reasonable to assume incredible growth rates over time. But it can be a really great strategy in all the right situations.